Hi children, today we are going to study about the incidence of tax. Let us understand the meaning of incidence. The general meaning of incidence means rate of occurrence. So what do you mean by this rate of occurrence? See, rate of occurrence means an individual who earns or receive in a particular country. Whether if, for example, if I take in India, what he is going to earn and what amount he is going to receive in India. That is an incidence. Based on the incidence, we are going to pay the tax. An individual is going to pay the tax. See, we'll come from the beginning. What it says, the income of a person or an individual, a tax is paid to the government based on his residential status that already we have studied in the previous chapter. Residential status, he has to satisfy the basic as well as the additional condition. Three types are there. One is a resident and ordinarily resident, resident but not ordinarily resident, and non-resident. Based on that, an incident will happen. On that, he is going to pay the tax. See here, three types of incomes are we have derived. One is an Indian income. The other is deemed to be Indian income. The third is foreign income. Let us understand what do we mean by an Indian income. Very simple. Indian income means any income which is earned, raised, accrued, received. Earned means which is earned in India. The income which is generated in India. Raised, again, that is earned or the happening in India. The income which happens in India. Accrued, not yet received, but it will come to India. Received, the income I have received the money in India. So the basic any of the one category which falls in India, that we call it as an Indian income. Either it can be earned, raised, accrued, received. In India, happens in India, that is called Indian income. Okay, understood. Now we go for foreign income. Next will come foreign income. See, any income which is raised and received outside India, not in India, which is raised. The income happens outside India, received outside India. India is not concerned. Those income, we call it as a foreign income. Next, deemed to be an Indian income, which is received and raised outside India, but paid by Indian government. See here, a little bit twist is there. Income which is received outside India, foreign, raised, earned outside India, but the payment is made by the Indian. So example is an embassy. Indian embassy who is working outside India is not related to India, but he is an Indian employee who has been placed outside India, that is foreign. His salary will be paid by the Indian government. That is said to be as a deemed to be Indian income. Okay, now next we come for a conditions of incidence of tax. The condition states we have made in the three category. One is ROR means resident and ordinarily resident. Resident but not ordinarily resident, non-resident. See, if it's an income generated, Indian income which is generated is taxable in all the three cases. What are the three cases? Resident and ordinary resident, resident but not ordinary resident, non-resident. Any income in Indian income which is earned, raised, accrued, received in India, we treat that as an Indian income and it is taxable in case of ROR, NOR and non-resident. Deemed to be an Indian income, it is taxable in two cases, not in case of a non-resident. What do you mean by deemed to be an Indian income? Earned, raised, received outside India, but controlled by India. That is deemed to be Indian income. It is taxable in two cases. If he is a resident, it is taxable. If he is a resident but not ordinary resident, it is taxable. In case of non-resident, it's not taxable. Next comes the foreign income. Foreign income is it's stated as income raised and received outside India. That means income earned, received outside India, where India is not concerned here. In this case, if an individual is a resident and ordinarily resident only taxable. In other both the cases, he is not taxable. Okay. So this is some conditions, a simple way which we have done. Okay. Now we go to a main chart that states at in which situation and the incidence in which situation, in which occurrence the individual will be charged as taxable. We'll see one by one. I'll read one by one. Children, be very careful while I'm reading. I will explain. Just make a note of it. Based on this, the problem will be solved. This will appear in the examination, 5th sem BCom as well as a BBA. This will be for 12 marks. Compulsory one problem will be there. Okay, we'll study one by one. Income earned or received in India. First, we'll understand the nature of income. See here, two things we need to observe. Income earned. Income earned means the income is generated in India, received also in India. So it is treated as an Indian income. Understood, children? Earned also in India, received also in India, we treat that as an Indian income. What will happen if an individual is a resident and ordinarily resident is taxable? If he is a resident but not ordinarily resident, it is taxable. If he is a non-resident also, it is taxable. Okay. So in all the three cases, it is taxable. Okay. Next, we'll go first. Oh, I hope so. First point you have understood. The second, income not earned in India, but received in India. Income which is not earned in India, he has not earned, but he has earned somewhere else, outside in the foreign, he has earned. The income is generated there. But the amount has been entered into India, received India. See, what did I say? Indian company, Indian income, basically four category. One is earned, received, raised, accrued. Accrued in the sense future we are going to receive. In this four case also we treat that as an Indian income. So this is also, see, I have marked in red. It states that received in India, anything. Here earned, received are there. In the second stage, India is receiving the money. So we call it as an Indian income. We call that as an Indian income. So Indian income. Again, it's taxable in all the three cases. If he is a resident but not ordinary resident, non-resident, all the three cases it is taxable. Income earned in India but not received in India. See again, one more. What did I say? Indian income, if it is earned, raised, received, accrued, all are Indian income. See, income is generated in India, but the income is not received. They are received by some other foreign country, even though whatever may be, it is earned, generated in India. So we treat that again as an Indian income. Again, it is taxable in all the three cases. If it is an Indian income, it is taxable in all the three cases. Income earned and received outside India from a business controlled in India. See, income earned and received, both earned also outside, received also outside, but controlled in India. This is basically deemed to be Indian income. I told the example of an embassy. Likewise, a person, Indian person, who on behalf of India has gone to a foreign abroad where he is earning there and he is receiving there itself, but business is controlled from the India. So this also we treat as an Indian controlled income. This we treat here as a controlled income. Controlled income. This controlled income basically is taxable if he is a resident, and ordinary resident. In case of a non-resident, if an individual is a non-resident, it is not taxable. Understood, children? Not taxable. Income not earned, not received in India. Sorry, one more. Next I have left. Business control India. Income earned and received outside India from a business, not controlled from India. Income earned and received outside India, but it's not controlled. Nowhere Indian role is there. The income which is earned outside India, received, the money also has not come to India. Both outside has taken place, where the head office also it's not in India. So in that case, we treat that as a foreign income. It's taxable only in case if he is a resident, it is taxable. In other two cases, it is not taxable. Okay. Income not earned and not received in India. Income not earned and not received in India. Same. Income is not generated in India, not received also in India. So we treat that as a foreign income. Taxable only in case if he is a resident and not taxable in case of other. Past untaxed foreign income brought to India during the previous year. Here we need to understand. See, some income, what will happen? All the income of the previous year that we are going to, it is taxable. But sometimes what will happen? An individual, he will work in abroad. So there he is going to pay the tax. Okay. When he is coming back to India, he will bring some amount. Here, it is not taxable. Any amount, if it is concerned with the previous year, then they will question it. If it is not related with the previous year and past untaxed amount, which is earned in foreign, which is received in foreign, when it is brought to India, which is not related to the previous year, then it is not taxable. Okay. It is not taxable. So that is exempted. Exempted, I say that as an exempted income. Say not taxable in all the three cases. Understood, children? Next. Any agricultural in India, again, it is exempted, not taxable. Agricultural, any agricultural related income generated in India within Indian territory, that is not at all taxable. It is exempted. Next, agricultural outside India. See, any agricultural outside India, we treat that as a foreign income and it is taxable in case of a resident. It is not taxable in case of a, it is not taxable in case of resident and ordinarily resident and a non-resident. See, next we'll go. Any gift received cash from the relative or a marriage by will not treated as an income. See, if any gift received from a relative, a blood relation, maybe from your uncle, auntie, or some relatives, if any gift which is received, that we don't treat as an income. So if we don't treat as an income, that we are going to recognize as an exempted income. If it is an exempted income, again, it is not taxable in all the three cases. We'll come to the next, children. Any gift in cash received from the friends or non-relative more than 50,000. See, if I receive a gift from the non-relative, from the friends, a close friend, I receive a gift in the form of a gift. If I receive 49 rupees, 49,999, it is not taxable. If it is more than 50,000, that means 50,001 rupee also I receive, that is taxable. So basically, any gift which is received from the friend or non-relative, which exceed 50,000, it's taxable. Indian income, I say, it is taxable in all the three cases. It is taxable in the case of resident and ordinarily resident, resident but not ordinarily resident, and in case of a non-resident. Any gift in cash received from friends or non-relative less than 50,000, less than 50,000, again, what will happen? It is exempted, not taxable. Only if it is more than 50,000, it is taxable. Less than 50,000, it is not taxable. That is an exempted income. As I told in the example, if I receive 49,999, is not taxable because it is less than 50,000. Exempted income. See, interest earned and received from Unit Trust of India, that is, we call it as a UTI, Post Office Saving Bonds, Defense Bond. In this case, it is an exempted income. Why it is exempted income? Because it is related to the central government. See, basically, any of the income which is generated by the UTI, post office, or defense bonds by purchasing, that will be helpful for the nation in the development. So, this is exempted income. That is a benefit of the country. So, they treat as an exempted income. So, when it is an exempted income, it is not taxable in all the three cases. Dividend from an Indian company. Dividend from an Indian company, we treat that as an Indian income and it is taxable. Any dividend received from an Indian company is taxable in all the three cases. Okay. Next, dividend from cooperative society. Again, any dividend which is received from the cooperative society, which is taxable in all three cases. That is resident and ordinary resident, resident but not ordinary resident, and individual is a non-resident. It is taxable in case if we receive a dividend from the cooperative society or if we receive a dividend from the Indian company, both are taxable and it is treated as an Indian income. Dividend from a foreign company received in India. Dividend from a foreign company received in India. Again, it is treated, it is received in India. See, the amount is coming to India. So we treat that as an Indian income and taxable in all the three cases. Share of a profit in HUF, that is Hindu Undivided Family. Any share of a profit that happens, we call that as an exempted income. That is, the income will be totally exempted. And when it is an exempted income, it is non-taxable in all the cases. So this is a chart which is related to the incidence of tax. And I hope so, children, you have understood. Based on this chart, we are going to solve the problem in the next class. Okay, we solve at least 2 or 3 problems related to the examination in the next class. Children, if you have not understood anything or anyone, if you have a doubt, just write it down in the comment section so that I can get back to you. Thanks a lot, children. Thanks for watching the video.